Nigeria's financial markets are entering a critical stretch. We are now firmly into earnings seasons. Monetary policy is back in focus with the MPC meeting on the horizon, and investors are trying to make sense of mixed signals across stocks, bonds, inflation, and liquidity. In this episode, we take a deep dive into how Nigeria's markets have traded recently and what could shape sentiments in the weeks ahead. So we will unpack company earnings, key sector movers and laggards, developments in the banking sector, the Nigerian economy, monetary policy expectations, inflation dynamics, and how pre-election spending may influence investor positioning. The goal is simple as always here on The Edge. We move beyond the headline and help investors understand what really matters for Nigeria's market right now and what to watch next. Joining me to discuss this topic is Oladipo Ajayi. Oladipo is head fixed income and vice president at Chapel Hill Durham. Dipo, how are you today? And welcome to The Edge.
Yeah, good day. Thank you very much, Dr. Kapo, for having me once again.
I really want to thank you for accepting to join me at the short notice.
It's always my pleasure. It's always my pleasure.
All right. So everyone, welcome to The Edge. We're going to be unpacking everything you need to know. So if you are new to this channel, please like this video, hit the notification bell, and subscribe. We're always here every week to unpack happenings in the Nigerian financial market and the global market. All right. So thank you, and let's get into it. So Deepa, I'm really curious where to start from, but I think let's talk about FirstBank. So last month, First Holdco, which is the umbrella body or the parent body for FirstBank, announced that its commercial banking subsidiary had met the 500 billion naira minimum capital requirement for banks with international authorization ahead of the 31st December deadline set by the Central Bank of Nigeria. A development that many would say is seen as supportive for investor confidence. However, the company recently released their 2025 results, which present a more nuanced picture. Gross earnings rose to about 3.4 trillion naira. Total asset increased to about 27.1 trillion from 26.5 trillion a year earlier. At the same time, the bank took a whopping 748 billion naira write-off on legacy bad loans, which is about 80% higher than the write-off they took in 2024. Now, leading the company to a 92% drop in profit to about 222 billion naira. So the question really is, how should investors begin to interpret the FirstBank 2025 earnings? Should you consider it a modest balance sheet growth on one hand, or a sharp collapse in profitability driven by legacy loan cleanup on the other hand?
Well, when you look at these FirstBank financials, of course, it's not out of place because the central bank actually mandated bank to actually clean up their books. We've seen that happen to Access Bank. Access Bank did the same thing during their half-year financials. Zenith Bank has also told the same lie. It was only GT that's been smart enough to have done that last year. And so they took advantage of that huge FS gain to use that to actually write off some of these obligations. And what the central bank is just trying to do is to ensure that most of these banks can now fly lighter. because a lot of them were carrying a lot of baggages. And when you look at what happened in 2020 about the COVID time, the central bank actually gave a leeway to banks around the provision for debts. And one of the reasons why they did that is that that was about the time where a lot of companies were not operational, and servicing their obligations as at that particular point in time doesn't look visible. So the window was actually opened, and so what the current central bank governor did was to ensure that the bank recapitalized, which make them stronger. And on the back of that, everybody should actually clean up their books. And a timeline was given to banks to actually do this line. So what FirstBank did was just in line with the expectation of the Central Bank of Nigeria, so as to be in line with the expectation of the Apex Bank. And but when you look at the magnitude of the amount that was actually written up, of course, is actually humongous, 748 billion. That's huge shareholders' return that's actually been thrown away. And but don't forget that this is just more like trying to actually write up loans. But we also understand that there's every good chance that they can actually recover some of these lost loans because some of it we know the situation whereby First Bank has taken over asset of some of these defaulters, and at the end of the day, they will come to actually realize the assets, and one day they actually write these back as income into their P&L. And but when you look at the release of the result, the first reaction that comes to mind is to sell, and that's just so normal. And market actually reacted in that same manner.
We saw the price drop to about 40 or 41 naira, isn't it?
Yeah. So market dropped. It traded as low as 41 naira levels, and but we noticed that 41 suddenly became the floor for the trading of FirstBank. And I would say that that is more like $40 syndrome, because why I said that is because investors were also looking at the highest shareholders in that FirstBank may also take advantage of that to actually consolidate on his holding. Don't forget that he just sold his stake in Gerigu, which simply means that he could be sitting on cash, and so he may as well just wait for people to actually dump the stock and actually come in to actually mop up some of these instruments in the market. Because for him, he feels that there's value that a lot of people could not see. So he feels that if you can't see it, then I can see it, and I can actually take advantage of that. And we saw how market has actually moved from that 41 level. As of today, the market closed at 49.75 on FirstBank. That's a whopping 8.75 kobo movement. So it is more like the market trajectory around that. So when the price drops, it presents opportunity for people that were actually looking for to actually buy at a lower price.
Okay, so I think that's interesting. So with the management, as you mentioned, I read a couple of tweets from $40 since FirstBank released that result. So with the management describing the 748 billion naira bad loan write-off as necessary but painful reset, how should markets think about its implication, one for asset quality, regulatory alignment, capital efficiency? And do you expect, you already talked about some momentum coming back to the stock. Do you expect this kitchen sink approach that the management or the bank to have a meaningful impact on the company's equity and stock performance in 2026?
Well, I think the first way I would look at this is more like I would look at the top line of FirstBank, and that's also very key because what simply means that it tells me their capacity. I want to check their non-interest income. I want to check their interest income, and then just oppose that to see that how strong can they actually make returns or sweat capital. Because that to a great extent determines the performance of the bank. And you look at it from this angle that if FirstBank can actually replicate the same level of effort necessary. It simply means that at the end of the year, it means that they can actually post a return close to 1 trillion after tax. Because if you look at 784 billion coupled with the little value remaining, so that means the total profit after tax would have been maybe north of 800 billion. And for a bank that can actually...
It was a reduction in about 92% thereabout, actually.
Yeah, exactly. So what I'm saying is that if you had what was actually written up to the current profit after tax, of course, it will post, they could have posted over 800 billion in their financials, and that's profit after tax. And so when you look at that from that perspective, it simply means that they have the capacity to actually sweat the asset. And by the way, they have actually removed those heavyweight assets that actually been drawing them backward. So it simply means that FirstBank can actually fly lighter. It simply means that currently the asset quality has improved significantly. And that's one of the reasons why I said that a lot of investors have waited for market to react so that when you get to a level that they feel that, oh, this look at a very good pricing compared to what happened. And they actually ran into the market and took advantage of that. And the only concern is that FirstBank may not be declaring dividend for the year 2025. That's only the concern for investors. But most of what you just look at is that you look at it discounting the dividend from the current price. Does it make sense for me to buy? Okay, let's look at it from this angle. At the time, prices were around 49, 50 naira, the levels, you understand? Let's assume you're expecting like a 5 naira dividend. So it simply might buy, if you remove 5 naira by 45 naira, you feel that's a very good buy for you. That's a net of the expected dividend.
Net of the expected dividend.
But the instrument actually traded as low as 41 naira, which is going to give you a better level to actually go into the market. So I feel that in terms of the asset quality, FirstBank is better now. In terms of management, they are actually more transparent. In terms of management as well, they've learned from the past mistake of actually aggressively granting loans to the oil and gas sector, and considering the risk the inherent risk that comes with that. So when you sum all these things together, it looks to my mind that FirstBank should be in a better position to actually move better from here.
So, which, in a nutshell, I mean, I've not heard that, from you in categorical terms, whether it presents an investment opportunity for investors in 2026.
Well, for me, and that's why I'm actually very conservative with my words, because I would have, actually, when we are speaking over the weekend, I would have told you that investors should wait to actually buy around 41 levels. Because to my mind, that would have sounded more like a very good price that has factored that level of provision that FirstBank actually made in their financials. But now that the rate is back up at 49.75, so it's more like a concern to me. Do I think there are not better banks that present better opportunity than FirstBank at this particular point in time? If we are speaking around when the prices were around 42, 43 level, for me, it could have been a buy, but now I will actually take it as a hold.
Okay. Because I think the stock has rallied maybe about 20% thereabout since that result. So it might be necessary to see or wait to see what happens going forward. So, Nico, let's talk about the broader market now. So the Nigeria's markets started 2026 with notable macro shifts, including external reserve growth, improved naira stability. I saw the exchange rate somewhere around 1,375 or thereabout. While the equities market remained sensitive to liquidity, sentiment changes, earnings, and earnings as well. So Nigerian equities have moved or they've shown mixed signals in the market recently. So we've seen mixed momentum reflecting a balance between the macro optimism and, in a way, valuation concerns. So over the past week, how would you describe the underlying tone of the Nigerian stock market? Are you seeing an opportunity for investors to come into the market? Are investors positioning defensively or selectively adding risk, or simply just waiting for clearer signals?
Well, for 2026, we've seen a bit of different perspective to the market. And
Okay.
at the point in time, we saw a market that was very aggressive, where buyers were heavily in the market. I think about the third week of January, we noticed a bit of retracement, and that was on the back of there was seller of WAPCO in the market. And towards the end of the year, we saw renewed interest in the market. And don't also forget that market majorly stocks with huge capitalization has greater effects on the whole market index. When a stock like Dangote Cement, like Aradel, all these big cap stock, when they actually falter, you tend to see the impact in the market. And I think that's one of the things that actually happened in the third week of January. But when you look at everything and you want to have more like a one view around the you'd have seen a market that's be very active. And we've seen a lot of interest both from the local and the foreign investors in the market. You mentioned earlier on that Naira dollar currently trading around 8,370 levels. But I made bold to say that the market closed at 8,500 and 8,355 levels yesterday at the higher window. So it simply means that we already are getting closer to the corridor. I remember one of the programs I told you that I will pitch that the currency will trade between 8,350 and 8,450 for the year 2026. But when you look at
we're already very close.
We are close to the lower band of that market. And one of the things is that it's not a market where we'll be seeing central bank actually participating in the market. It's basically for foreign investors has been aggressively present in the market. They've been actually aggressively present across board. We've seen them in the bond market. We've seen them in the OMO window, and also we've seen traces of them also in the equities market. But one thing about them is that most of these guys, they look at quality names. And in the banking sector, they like GT, they like Zenith in the banking sector. They also like pockets of other instruments like Access Bank as well. And these are some of the names that some of these guys looked at. That when you're looking at the building sector, they like Nigerian breweries. When you look at the oil and gas sector, they are big on Seplat. They like Aradel as well. And so it simply means that it's more like cherry picking. It's not broad market activity that has actually driven the level of activity in the market. Most of these guys, they come to the market strategically. And like I mentioned to you, in the month of January, there was an heavy seller of WAPCO, and that's what actually led to the market tanking that we saw. That we saw in that week. And but aftermath, we've been seeing more renewed interest in WAPCO. Just yesterday, WAPCO announced that they want a capacity expansion in two of their plants, one in Shagam and one also in the northern part of the country. And the end goal is that simply means that they are looking to increase their production capacity. And when you are increasing your production capacity, of course, it means that that will actually impact your top line, which at the end of the day will also filter to your bottom line as well. And it made good to say that it means that the dividend return to investor will likely increase. And that will also be factored into the activity that you will see in the market. So when you look at the overall market, it's simply about investors looking at each sector and looking at what names in these sectors can actually give me that great return. And beyond return, a lot of investors are also looking at portfolio stabilizer stocks that can actually weather the storm. When there's volatility, they can actually help to actually diversify the risk.
Yeah, I agree with you. And I believe that investors would also be watching critically the earnings that are released by these companies, where fundamentals now begin to matter more than sentiment. So as Nigeria companies move into the earnings season, what should investors pay closest attention to? Is it top line growth, margins, FX exposure, balance sheet strength, given the current macroeconomic conditions? We already saw FirstBank shed some weight in this regard.
Well, I think the investor needs to look at every indices to be very sure that they're actually making the right decision. You look at the top line, what's happening top line, revenue growth, that's also very good. You look at the cost of sales as well, or cost of fund, as the situation may be. And what we get, that's the greatest also help you to actually see how much margins our companies are able to actually make from the business. And at the same time, you also look at the operating expense as well. And that to a great extent tells you the efficiency of the company, how efficiently the company has been able to actually run the business. You look at their financing cost. You tend to see there are some cost companies that part of the problem they've been having is more like finance cost. And when you look at the top line, you are doing growth. But when you get to finance costs, you find out that they've not been able to actually access finance funding at a cheaper rate. So that's actually putting a lot of pressure on the business. So you tend to also want to look at that so as to be able to know whether this actually works well. And sometimes you can also look at it from this perspective that now that interest rate is dropping, would that actually lead to a better performance for the company? And also that help you to actually gauge and make the right decisions. You look at the cash flow statement as well. That's very essential. That tells you to a great extent how healthy the company can be in terms of meeting their financial obligations as a when due. Beyond profitability, liquidity is also very, very essential because sometimes liquidity is even stronger than profitability because a company can be profitable, but if you're not very liquid and you're not meeting your obligations as a when due, that may actually mean the end of such company. So you have to actually be able to look at that. And all in all, you look at your profit after tax, what is actually profit after tax. And if it's a dividend paying company, you look at what is the dividend yield, you look at what is the EPS, you look at the price earning ratio. These are some of the metrics that you use. And what do? You sometimes you compare them with the market standard. What is the market standard? You look at related companies in the industry. For example, maybe you are looking at the cement industry. Then you are looking at the books of Dangote. Then you cannot compare with companies like Bois, something like Lafarge. What that would do is help you give you a range or a guidance around where a market is supposed to actually trade, and that to a great extent also help you to actually make the right decision in all this. But for investors, dividends is also very, very essential because most times when you have invested, also you of course you want something to actually relax after a whole year. And if companies are not paying dividends, of course, it becomes a concern to some investors. But I would not say that it's actually totally bad if your company is not paying dividend. We've seen MTN the year 2024 never paid dividend because of the impact of the FX loss on their financials. The FX loss actually took the shareholders' fund into negative. And on the back of that, they couldn't actually pay any dividend to customers. But this year, MTN paid a 5 naira interim dividend. And market is actually expecting like close to another 20 naira in their full year dividend. So it simply means that you must also be able to look beyond that. Is the company paying dividend now? Why are they not paying dividend? What will be the impact? So that to actually take advantage of that. Some people bought MTN at 180 when they were not paying dividend, and some investors were dumping MTN. And in January, MTN traded 605. So imagine you have bought MTN at 180, and that was just early last year. And now the stock is actually trading 605. So it gives you an idea of how capital position can actually compensate for the dividend income that you lost.
Obviously, an investor's total return is a combination of capital appreciation and dividend yield. So
Yeah.
you are not getting dividend yield, but you are enjoying capital appreciation. So that's also, you can also look at that as being sufficient for you to take a decision. And you talked about cash flow, liquidity, and all that, which is key. And I agree with you. If a company might be profitable, but if you don't have the requisite liquidity or the cash flow to even take advantage of opportunities, then that the growth, the company's growth, especially the bottom line, might be stunted going forward. So let's continue on our discussion about this earnings period. What sectors do you expect to be the key movers? I know the companies are just releasing their results, but I'm just trying to get a sense of what you are thinking about. What sectors do you expect to be the key movers in this reporting season? Are you thinking it could be banking, consumer goods, industrials, oil and gas, telecoms? Which sectors look more vulnerable as well?
I think if we look at it critically, there are three sectors that actually came to our mind, and that will likely be the driver of the trading earnings this season. And the first one that came to my mind is the banking sectors, and they've always been the big guys in during earnings season. And a lot of people are waiting for results of banks like Zenith, GT, Access Bank, UBA, and the host of other tier two names. And also markets actually waiting to see Fidelity is among them. We've seen the interim, the unaudited result of FCMB, and that was a wonderful result. Also, we've seen Wema release results, which also shows that it was a very good performance. And don't also forget that a lot of people are waiting to actually see, because most of these banks just recapitalize. So the market wants to see how much you have been able to actually sweat your additional capital that you have been able to raise. And so markets now comparing what you did last year in comparison to what you're currently doing now. So we feel that sector will actually drive at the earnings season. And beyond that as well, we feel the telcos as also the big boys in the room. You have names like MTN, you have names like also driving the market in that segment of the whole market. And so we feel that Airtel has released their results, which also very good. We are expecting MTN to actually release their results as well. And also, we are also looking at the oil and gas sector as well. Aradel released their results about 48 hours ago, and we noticed improvements in their bottom line. They've been able to actually grow their bottom line to north of 400 billion profit after tax, and that's actually commendable. And beyond the profit element, also the asset size has also increased greatly. And because of the acquisitions, so we've seen the impact of the acquisition, also the asset side. So it simply means that that sector is a sector that we need to look out for in this year, 2026. We need to pay close attention to the oil and gas sector because most of these companies. Yeah, you want to say something?
Yeah, so I was going to say that you are tipping banking, telecoms, and oil and gas as three key sectors to watch.
Yeah, exactly. So I feel that these sectors will actually drive the market.
Okay, all right. So we also seeing that on the fixed income space, we are seeing elevated yields available in that market, which continues to provide or offer investors a genuine alternative to equities. So with attractive yields, even though you will tell me that yields have dropped significantly in the last 1 week or so. So with the yield, again, those yield levels are still decent compared to yield levels maybe 5-10 years ago. Okay. So with attractive yields still available in the fixed income market, what will convince investors to rotate back into equities? Because we're seeing huge demand still in the fixed income space. What would convince investors to rotate back into equities? Would it be these stronger earnings that are going to be reported, lower inflation, or a clearer monetary policy direction?
Well, I think it's going to be a summation of all the three that you have actually mentioned. Good earnings will actually push a lot of investors back into the equity market. Like I mentioned, some of these companies, you expect them to actually post strong return, and these to a great extent will actually lure investors to the market. Like I said earlier, I said the telco guys, they are actually printing cash. So when you look at those guys as well, you expect them for their performance to also be a catalyst that will actually drive a lot of people into that segment of the market. And like you said earlier on, we'll see considerable drop in yield at the beginning of the year. Sometimes rates actually went as high as 18%. On the bond side. As we speak today, the market is currently straight around 1630 level. That's about 170 basis points from when the market actually climaxed this year. And I remember sometimes in January, I was telling people that this is a very good time to buy. Buy now because currently the government is still running a promo. And one of the reasons why I have that perception was because the level of liquidity that we expect to actually hit the system in Q1 alone is enough reasons for us to feel that rates will actually plummet in Q1. And exactly, we've been seeing that in pattern beyond the bond side also. We've seen that also infiltrated into the Treasury bill side as well. We saw that huge gap, because I will not call that drop, I will call that gap. Between when rates actually, the first auction, NTB auction for the year, when it was done at 1847. And now the last one that was just done yesterday was done at 1698. So you can see that level of gap between what happened in January and what's currently happening just less than 30 days after. So it simply seems that we are more like on a downward trough when you're looking at rates. And don't forget that we are still expecting the monetary policy guy to actually speak. And currently, market is liquid. We have a lot of liquidity sitting in the system. So by the time you don't have a rate cut, of course, you can imagine what could happen. Just yesterday, I saw somewhere online what I was reading about the index, JPMorgan trying to actually now trying to actually create more like a frontier bond index. And JPMorgan coming to market to actually create a frontier bond index will likely actually include Nigeria. Of course, there are rumors around Nigeria being included in this index. And don't forget that most time investors just look at the index, they look at country giving the highest level of return. They can actually have. So what it would mean to us is more exposure to the market, more exposure to the global world, more exposure for investors to actually come into the country. So it simply means that will help the FX leg, and also at the same time that will actually push yield down. And as yield continues to go down, a lot of investors will now be shopping for better returns, and that will actually rotate them back to the equity market.
Yeah, they were still talking about that Treasury bill auction. Where did those 4.3 trillion bids, where did they come from?
There are funds sitting in the system. There are high liquidity sitting in the system. And don't forget that this quarter alone, we are expecting over 23 trillion worth of liquidity to come back to the system. And and as we speak currently, the investors you are seeing in the window, they are not only local investors again. FPIs now get almost around 17.25. And you can also get NCB around the same corridor. So why do I need to wait until when the central bank calls out for when I can actually just go on a regular NTB window? And also the level of liquidity that you see on NTB trades cannot be compared to the one you see on OMO bills as well. So beyond the local investor, beyond local portfolio manager, and beyond local traders, we also saw the interest of foreign investors that actually participated in that auction. And don't forget that last auction, OMO auction, the central bank did not take every fund. So it simply means that there are still some people sitting in the system. And also this week alone, we've seen over 1 trillion mature into the system in form of OMO maturity. And these funds are actually looking for where to actually go from there. And the central bank has not been to the market this week. So it simply means the only option for them is to actually also participate in the NCB auction.
So investors are having reinvestment risk as we speak now.
Yes, exactly, because a lot of them invested earlier on at 22, 23%. That's go to 28 effective yield. But currently, rate has dropped. And that's one of the reasons why the advice we gave to some of our clients then was that buy bonds rather than buying treasury bills.
Yeah,
because when you buy bonds, when you buy bonds, imagine you buying the January 35 bill. Bond at 22.60. So it means that you're sitting on 22.60 for 10 years. I don't think there's any other risk-free investment that actually that can actually bring that level of return to anybody anytime soon.
Okay, Dipo, even as we talk about the amount of activities and momentum, the volume of bids coming into the fixed income market, but inflation still remains a concern. It remains one of the biggest constraints on whether corporate performance or household demands. How do you see inflation evolving in the near term, and what does that mean for consumer-facing companies versus more defensive or export-linked sectors?
Well, the expectation is that inflation will continue to drop in the year. Of course, in the month of January, we expect a bit of retracement to around 18, 19%. And that is premised on the base year effect. So you expect that to actually push inflation up in the month of January. And that's one of the reasons why a lot of people may not be expecting the first rate cut in the month of February, considering that as at the time they might be going to the meeting, they might actually be working with a higher inflation figure in January. And but post-January, we expect inflation to continue to actually nosedive throughout the year. The expectation is that inflation will likely print below 14% by year end. And when you look at that, in comparison to where we're coming from, it simply means that we're on track. And don't also forget that the current central bank administration, they are more of they are actually into more like orthodox policies, where the first thing is that that preservation is very essential, and also simply means that they understand very well that they need to ensure that Naira is stable. They need to ensure that there's not a lot of liquidity in the system pushing pressure on the currency. So when you look at that all, it gives you a sense that inflation will continue to drop in the year 2026. And just some days ago, Ghana released their inflation figure for the month of January. And currently, the inflation is around 3%. And to my mind, this same country printed about 50% some months ago, and when done like about 36 months ago, and currently they are currently at 3%. So it simply means that it's not impossible for Nigeria to actually move back into the single-digit terrain. We've been there before. Before now, the corridor used to be 6 to 9%, and so by the time we move back into that bracket, what that signal will send is that we are now currently in a low interest inflation environment. And what that will mean that will actually help some of these companies, more like the consumer companies, because it will increase the purchasing power of the people, and it will help them to actually be able to buy more. So if you're able to buy more, what it will mean to you is that the company will need to produce more. If the company produce more, it means that they will need more people to actually help them produce. So if you employ more people to produce, you create more job opportunities. And when that is done, it will create more growth in the economy. And that's one of the reasons why the road of travel of inflation is actually very, very essential to any government.
Okay, people, just cycling back into the fixed income market, I think the Treasury bill, 1 year Treasury bill, likely going to close the week around maybe 15 or 16% levels. Are there still room for further drop in yields, given your expectation that inflation will be around 14% will close around 14% the for 2026?
Well, to my mind, there's still a lot of opportunity for drop. When you look at the bond side, in the month of November, we were trading at 15%. And so when you compare to where we were there and where we are currently trading now, so it tells you that currently one way or the other, rate has actually increased between now and then. And then inflation was actually higher than where we are currently. So, and based on everything that I've actually highlighted in terms of expectation that the monetary policy guy will actually touch rate and actually reduce rates this year. For me, I'm expecting at least minimum of 2 rate cuts in the year 2026. And this will actually impact on yield. It simply means that will actually drop rates. So for me, I won't be surprised if by the end of the year, we're already trading around 13 half on more like the belly of the curve instruments. And at the same time also, just like what I said around JPMorgan actually preparing to actually constitute a frontier bond index. By the time Nigeria is listed on this, we've seen this happen in the past, and market has memory. And so we know what could happen, and we know the trajectory at which rates could travel. Imagine an inflation environment where inflation is at 7%, 8%, or 9%. Of course, you will not expect yield to be around 11% because we've been there before. So, and that's one of the things why I said that investors should keep tab of where inflation is going and look at the road at which inflation is traveling. And that's help you to get sense to be able to make a very good decision. If I'm an investor currently, maybe an high net worth individual, I will aggressively be buying bonds now. And why would I be buying bonds? Because I know that in times to come, 16% level will be a mirage. Because at a time when the first time we thought 16%, it was more like that something great is happening, as if the world is coming to an end. But here we now it's becoming enough. And but I know very well that as the economy continues to improve, we will now look back and say at the time we used to trade at 16%.
Yeah. So therefore, let's switch gears a bit and look at global monetary policy and obviously emerging market flow. You already started talking about what JPMorgan is planning to do about the frontier market. So the US Fed recently kept rates unchanged. And now we've had the Trump's administration announce a new chair or a nominee to become the new chair. That's going to take place, or the nominee is expected to resume office, I think, in May. So with the Fed holding rates and with the new leadership on the horizon, what are the implications for emerging markets like Nigeria, especially for foreign portfolio and FX, foreign exchange stability?
Well, if you look at what's currently happening in the United States around that, you look at before now, we have more like a pragmatic leader in Jerome Powell, and currently, for some time now, the president of the United States has been having a couple of issues with him, considering expectation that there should be more rate cuts and interest rates is too high in the United States. So the expectation was that maybe President Trump is going to nominate someone that has a bit dovish, that will actually be able to travel in line with his expectation. And but it was very surprising that that he picked
someone
Kevin
that is
Walz,
hawkish.
Was someone that is even more hawkish than the current U.S. Fed chairman. Yeah. And so to our mind, that's more like causing a bit of confusion. And that's one of the reasons why we saw that yield drop in commodity price over the weekend. because when that announcement was made, a lot of people have invested on the back of the expectation. So because when you're expecting to see a dovish US Fed, so it simply means that you are expecting the currency to actually depreciate. And when you're expecting US dollar to depreciate, then I would rather fly to a better safe haven in commodity. And that's why we're seeing gold actually touch new highs. We're seeing silver actually trade new levels. And but the announcement of Kevin Watch actually turned everything around because a lot of people were expecting a dovish leader. But now the nominee was actually more like someone that's actually a bit hawkish. But the concern is that will he travel the route of the current US president? I think I will leave that to. But if I want to actually judge by his personality, so what it simply means that we may likely see interest rates elevated in the United States for a longer time. So it simply means that the expected rate drops that we have actually anticipated, we may not see those jumbo rate drop in the year 2026. And what that will simply means that we may likely see more like a capital reversal back to United States. Some investors have actually invested in frontier economy. And just in anticipation that, okay, this is what they expect will happen to the US dollars on the back of the expected US Fed. But with what has happened now, we may likely see more like a capital reversal where most of these people take back their fund into the United States. And that will, to a great extent, put pressure on the emerging frontier market currency. And also, that also put a bit of pressure on the asset in those countries because you likely see most of these investors dumping those assets in the emerging markets are moving back to US dollars, considering what we're seeing. So I think we would like to actually see what would be his inaugural statement. To a great extent, it tells us whether he's going to wear the normal cap that we have known him for, which is more like a hawkish cap, or he's switching cap with the president of the United States, and he will be donning more like a dovish at donning his time.
So you're saying that we might see some reversals in investment, which will put pressure on the foreign exchange of emerging markets.
Yeah.
Okay. Now let's come to the Central Bank of Nigeria's MPC expectation and their policy trajectory. So the upcoming MPC meeting, which is scheduled for the one scheduled for February, it's a key event for both investors in stocks and investors in the equities market. So heading into that MPC meeting, even though we would still have a pre-MPC meeting chat, and I ask everyone to join us for that, we'll be having a preview of the MPC meeting. But let's have your take on this first. So heading into that MPC meeting of the Central Bank of Nigeria, what do you think policymakers are more focused on right now? Would it be inflation, FX stability, supporting growth? And how might that shape market expectations going forward?
I think the first thing that will be on the table is the level of inflation in the economy. Okay. And of course, growth is not their key KPIs. Okay. And of course, that will fall on the table of the fiscal policy guide. So actually, on the table, the key thing is stability of the currency. And when you're looking at the stability of the currency, you're also looking at inflationary pressure as well. So inflation will be one of the focal points that they will actually be looking at. And that's one of the reasons why I said that for me, I'm actually not so bullish at a rate cut in the month of February. And my view is premised on the fact that the month of February will just be the month where the inflation figure for the month of January will be released. And don't forget that the inflation for the month of January, like I mentioned, we'll see the base year effect on that, which may actually push inflation to around 19%. So would the monetary policy guys be ready to actually cut rates when inflation is actually 19%? Of course, I'm very sure that they would likely want to look at the wait and see game to actually wait until the month of May to actually make a decisive decision at that particular point in time. You don't want to do more like a policy somersault where after reducing rates, you now look at some other things, you come back in the next meeting to actually increase or reverse the reduction that you have done in the past. As we speak currently, the global economy as well is also not a factor that they will look at. They will look at what is inflation, global inflation looking at. Just recently, we saw what happened in Australia when the Central Bank of Australia actually increased rates and where tells us that currently, as we speak, beyond what is happening in Nigeria, what is happening in global economy is also a factor that we also need to reckon with.
Okay. Obviously, people, we are in the pre-election year. Okay, so pre-election period often comes with higher government spending and liquidity effect. So as we approach the pre-election environment, how should investors think about the impact of government spending on liquidity, inflation, and sector performance? And which part of the market historically benefits or suffer the most during this period?
Well, I think I'll look at the part of market that actually benefits the most, and I sector benefits as well because of the level of liquidity that will flow within. Also get the election year, the year where the government try to actually consolidate on their stories. And what do I mean by consolidate on their story? They want to quickly finish unfinished projects. So you tend to see them running aggressively on infrastructural developments. And so it simply means that the cement and name is also a factor that we also need to consider very well. And don't forget that currently we have a lot of projects going on in Nigeria. When you look at from the Badagry to Sokoto Road, or the Coastal, the Lagos to Calabar Road, or beyond also that there are a lot of other projects actually going on. And so the government would want to make statements. So it simply means that they will actually need to actually pump a lot of liquidity into that segment of the economy. And that will also affect investors positively in the market. So for me, election year comes with its own challenges, and because it's more like a year where you don't have 12 calendar months. I was telling someone that by the time we are in September, that would have been more like the end of the year, because by the time we start the primaries now, after the primaries, the next thing is to start campaign, because by come February, we are going back to the polling booth to actually pick who actually wears the crown once again. So I feel that investors just need to be very sensitive to the market. And on the part of the liquidity impact of the economy, I think the current central bank governor is actually very knowledgeable in that regard. So we may likely see a bit of more aggression on the part of the central bank towards that time, trying to actually mop liquidity from the system. And one of the reasons is that so as to reduce what would likely be the inflationary impact of some of these funds being pushed into the system.
Okay. As we begin to wind down, people, investors must balance between the investors must balance volatility with opportunities at with both domestic factors like liquidity, FX stability, as well as international signals that you already elaborated during this chart. So given all of these moving parts with Naira stability, external reserves, global rate outlook, oil price, volatility, and earnings, what tactical guidance can you give investors over the next week for positioning between stocks and the fixed income market?
Well, it depends on behavioral pattern of the investor that determines how the investor will actually play. When you're looking at someone that is a risk taker, I think I'll be more bullish in the equities markets. And like I mentioned, there are good names in the equity markets. There are credible names where you can actually push your fund that can actually give you a sizable return that can also help you to actually cover the inflation rate. And for me, if I have an opportunity, I will be pushing close to about 60 to 70% into the equities market, and maybe the 30% goes to the fixed income market, and that now depends on how I want to actually allot it in the fiscal market. Do I want to go majorly to the treasury bill side, or if I had this, just like what I said, expectation is that interest rate will drop in the future. So why do I need to invest in a short-dated instrument? We have a lot of treasury bills that are maturing now. A lot of investors invested when the effective yield were around 25%. Currently, they barely can get 19-20% in the market as we speak currently. So it means that that will expose you to the investment risk. So I'd rather actually choose to actually invest in a long-dated bond instrument so as to actually help me enjoy the impact of this elevated yield over a period of time. So I will be voting for more like a 70-30. Then the 17 I can actually a lot based on what I've spoken around earlier on the banking sector, the oil and gas, the telecom sectors, the consumer names as well, the brewery sector as well. So a lot of these things are some of the things I will actually need to consider. Then I can actually pick some of the stocks, then invest accordingly.
Okay, so there you have it, everyone. Dequa is looking to build a portfolio where about 70% of the investments will be locked in on equities and banking sector, oil and gas, brewery, companies in the brewery section, telecom section, dominating the stocks that he's going to pick to invest that. So thank you, Deepo, for your time and your insightful analysis as always.
Thank you very much, Dr. Tony Okafor, for having me once again.
All right. Thank you, everyone, for watching again. If you've enjoyed this episode, we are here every week. Please like this video. Send any questions that you may have. Share this link with your communities and subscribe to this channel. Thank you, everyone. We are out. Bye.